we don't know. And we don't know. Maybe it's good, maybe it's bad, we don't know. But here's the way I like to think about it. The risk of it, what if it's really bad? Why take the risk? Yeah, it's expensive. But here's my problem is we're not addressing that problem and the risk around it in a rational manner. And that's my dislike for ESG is let's solve this problem, but let's do it in a rational manner that actually gets results.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
A new world order is emerging, and in our Global Macro series, I, along with my co-host Cem Currie, want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Our guest today is one of the most sought-out people when it comes to understanding the global natural resource shift we're witnessing right now. So please enjoy our conversation with the head of Commodities Research at Goldman Sachs, Jeff Currie. Jeff, welcome and thank you so much for joining Cem and I today for what I'm sure will be an incredibly eye-opening and insightful conversation on all things commodities. How are you doing? How are things so far in the new year?
Oh, I'm doing well. Happy New Year to both of you. And I'm excited about commodities in 2023. So I'm looking forward to this year.
Yeah, no, absolutely. Now, Jeff, since this is your first time on our podcast, I know you've been on many other podcasts, maybe to provide a little bit of context to our conversation, do you mind sharing just a few highlights in terms of your background and actually possibly what was the biggest impact on you that led you to do what you do today and focus on the commodity space?
Well, I am the head of Commodities Research at Goldman. And before that, I was an academic economist and I was at the University of Chicago. And to answer your question, how I got into the space was I came out of school in 1990, in the middle of Gulf War I. Oil prices were at $40 a barrel. Nothing else in this world was hiring but oil companies. And so I got a lot of information in my first job before completing my PhD on the oil market. And when I went back and finished the doctorate, my dissertation was on the geographic extent of the oil market, looking at how far does one oil market connect to the other one? And in the early 1990s, oil was the largest, most global fungible market. And so it had, much more interconnection. But even today, with all the technology, things like mountain ranges and things like that still create fragmented markets. So that's how I got into it. And I'm still at it, little over 30 years later.
Yeah, no, absolutely. It's fantastic. Now, I followed your work for a while, and I have to say, every time I hear you speak, I walk away having learned something new or I've been inspired to think about a topic in a different way. And I think that many people around the world who may not have thought too much about how commodities and energies in particular impacts pretty much everything we take for granted have found a new appreciation of this in the last 12 months. So we've got a lot of ground to cover. So let me just start out by throwing out a topic that I know you spend a lot of time thinking about, and then we'll just take it from there. And I think perhaps we can start out by focusing on what is different about what became clear to everyone in 2022, namely the interplay between commodities and inflation, and how the current inflationary period is different from previous periods such as 2008 and maybe even also the 1970s?
Well, I think first and foremost, what characterizes this period versus any other is the focus on decarbonization. And as a result, we're seeing it very difficult for the sector to be able to create the supply response it typically would under these types of pricing conditions. You look at how undervalued many of these different publicly traded companies are. They currently have the economic incentives to do share buybacks with their cash flow as opposed to drilling for new oil. I don't want to get into debate whether that's right or wrong or whatever that might be, but I think that that distinction is really important here. And it's not just happening in the oil sector. It's happening in all of commodities, because let's remember the old economy creates 80% of the world's emissions. And as a result, it's the dirty sector. The new economy is clean. So if you're an investor just trying to stay away from, the entire debate around decarbonization, just ignore the old economy and you'll be safe. And unfortunately, that's kind of the approach that many investors have taken. And as a result, the ability to track capital into the space has been severely constrained, and we saw evidence of that last year. And I think some of the listeners are like going, hey, wait, aren't oil stocks up 60% over the course of the last year? Yeah, absolutely. But I want you to think about what that trajectory looks like between oil stocks and oil equities going back to 2017. It's a dead cat bounce in terms of thinking about correcting the decoupling that has occurred between oil equities and the oil price. And it's not just in the oil equities, it's in the metals and miners, agriculture producers. All of them have a significant disconnect between the capital that they've been attracting and where the underlying commodity prices are. So if you're to answer your question, the distinguishing difference really boils down to the ability to get a supply response. And one last point on that is, when we think about approaching decarbonization, we've been big advocates of using a carbon price or a carbon tax because it doesn't create these distortions in investment. It's a flow through. And these distortions in investments are creating much higher prices than what a carbon tax in itself would create. But more importantly, these distortions are essentially a carbon tax where the tax revenues are not collected by the governments in US, Europe, and the different energy consumers around the world. So, these are questions that are going to need to be addressed by policymakers on a forward-going basis. But I think the key point here, and I'm belaboring the point, the big difference is the ability for the sectors to respond to higher prices.
Now, that's very, very interesting, Jeff. But there was one other thing that I also wanted to ask you about, because I've heard you talk about this, and this was something that when I heard it, I said, yeah, of course, that's so logical, but I don't hear many people talk about it. And that is also the difference in policymakers and how they have responded to these crises, these periods, and how that's changing. And also, I've heard you talk about which part of society actually creates inflation. And when people understand that, it just there's not many people who explain it as well as you do. So I'm hoping I can get you to expand a little bit more in those two directions.
Okay, yeah, absolutely. And let's start with, I'm going to make a statement here that may be, kind of shocking, is that ultimately commodity bull markets and inflation are created by low-income groups, not the high-income groups, but the low-income groups. And there's no exception to this observation. And I think a lot of people find it they find it disturbing because there's a belief that, hey, those that are in the low-income groups are the most vulnerable for inflation. No, the actual truth is they create it. And now let's go over why that is true. When we think about commodities in physical markets, they're what we call volumetric markets. They're driven by the quantity consumed. To be bullish an oil market or a copper market, it's really easy. You look at the volume consumed versus the volume supply. If demand is bigger than supply, you're bullish. There's no discount factors, no interest rates, just nothing. Either you're long or short the stuff. When we think about financial markets and even GDP, they're dollar markets. How do you quote an equity market? Billions of dollars of market cap. How do you quote an economy? Trillions of dollars of output. The concept of volume is not defined. But things like interest rates, discount factors, all of that are very important in terms of creating a valuation. Now, when we just think about the simple flow or economics of commodity markets, it's just volume consumed. And in financial markets, just simply dollars invested. And now I'm going to make an observation. When we think about high income groups around the world, what do they control? They control dollars. Are there very many high income people in the world? Absolutely not. So they cannot control volume. In contrast, the low income groups control volume. So let's ask the following question. Can high income groups create financial inflation? Absolutely yes. One guy can go out and, take an Elon Musk. Well, he lost 200 billion this last year. Let's go back a while ago. He could have created inflation across any of these financial markets. But can he create inflation in a commodity market? No, it's numerically impossible. There's not enough of high income people that could create physical good inflation. Take corn. A high income guy consumes about the same amount of corn as the low income guy. And some of the listeners, I go, hey, what about the high income guy that has the private jet? Yeah, there's those outliers way out there. But on average, the high income guy consumes a little bit more oil, but not substantially much more. And I think that point there says the only possible way high income groups could create commodity inflation or physical good inflation, they'd have to hoard it. Now, is hoarding all the world's corn, oil even possible? Absolutely not. There's only one commodity the world's high income could hoard, and that's gold. You think about it, you can store all of Fort Knox gold in a very, very small location. I like to point this out. When you take the gold ETF, it's somewhere around $150 billion of gold in it right now. You could put all that gold in your office. May break the floor because it weighs so much, but you could put it in your office. Now let's take like the ETF on oil. At its peak, it was somewhere around 200. It's probably about 200 million barrels. And 200 million barrels, call it somewhere around let's call it $12-15 billion. So think about this. Now, if those listeners think about 200 million barrels, well, how many VLCCs is that? It's essentially 200 VLCCs. Now, vision in your head what a VLCC is. Those big, enormous ships. Now, I live here in London. Can you imagine parking 200 VLCCs out on the Thames? You can't do it. You're not going to be able to store all that oil. And that's a critical point here. So it is numerically impossible for high income groups to ever create physical good inflation. So the conclusion is only the low income groups can create that inflation. Now let's go to the first part of your question, which was, hey, you have policy. And so policy is actually making that supply problem I was telling you about before worse, but then accentuating the low income group. So let's take like here in Europe, they use a windfall profit tax, and then they take the returns from the windfall profit tax and give it to lower income groups. So what are they doing? They're actually making the supply problem worse and accentuating the demand issues. So anyway, I think I think it's a critical point here is that when we look at, the history of commodity bull markets, they're invariably driven by low income groups. What was the 2000 China story driven by? 400 million low income rural Chinese. What was the 1970s commodity story driven by? The war on poverty. And so I think that's the point that you're after. And it's really apparent in the current environment. And as we look forward, that interplay between decarbonization and income inequality is only become more critical and more critical in the commodity space.
Jeff, I think you said a few words that Jim likes to talk about. So, Jim, why don't you join the conversation here?
Yeah, this is 100% what I agree with you 100%, Jeff. I've been talking about for years the realities of monetary policy is essentially supply side economics. And it's been sending money to what I call Planet Palo Alto, right? It's been sending money to another planet where the money is sequestered, right? Not entering the economy, velocity of zero, if you want to use that term. And instead, they've been sending us really efficient goods back, Teslas and Ubers and Amazons, right? Which, ironically, all that money created is creating deflation secularly, and has been. So monetary policy is essentially a form of supply-side economics, and what we're getting in response to the inequality that we've seen for 40 years is a fiscal response, which has a velocity of 1. So I'm 100% on the same page. That populism and that rebalancing of inequality ultimately drives inflation, and that's why we haven't seen it for 40 years, but now that we're seeing that fiscal response, we are seeing that. So I agree with you 100%. I also agree with you on the supply side. Dynamics of commodities, right? Because of the underinvestment, because of the ESG, et cetera. My question to you is cyclically, not secularly, but cyclically, the demand side, right? That's the big question right now. If we look at 2023, 1 year is a relatively short period under a secular trend. So, you guys recently, I think, called for 40% plus outperformance of energy, of oil this year. How do you see the demand side in this year, not just secularly with the populist thrust we're talking about, but really given the Fed's desire to bring down the economy and the potential impending recession? Love to hear your thoughts.
Well, I think it's the single most important question for commodities in 2023. The biggest drag coming from in commodities in the second half of 2022 was really coming from the demand side, particularly China. And I like to point out, China is the largest commodity consumer in the world, the largest oil importer in the world, and it's the second largest economy. And it's been shut down. There's a lot of concern around, hard landing. I go, well, what are you waiting for? You got it. You got, Europe went through an energy-induced recession in the latter part of 2022, or a slowdown, whatever you want to call it. And China was humbled to its knees through rolling lockdowns due to COVID. Every indicator you look at tells you that you're inflecting right now. You look at China, whether if it's mobility, subway ridership, holiday bookings. I want to point the holiday bookings are quite low, but they're all beginning to sequentially turn up right now. And we look at China, it's abandoned the zero COVID policy. And one of the most compelling arguments I've heard about China is at this point right now, the number of people who have had or have COVID is quite high, which means that, in 3 weeks' time, a lot of these people are going to be testing negative and be wanting to take a holiday as you go into the Golden Week. And a lot of these people haven't taken a holiday in 3 years' time. And, if you are the government and the policymakers in China, you can go a long ways of recovering from those policy mistakes last year with everybody getting a refreshing 2-week holiday. So I'm a big believer in big Golden Week this year, which is just reinforce, the recovery. And in oil demand, you're talking, 1.2, potentially even 1.5 million barrels per day of sequential demand, over the next potentially 6 months, particularly if you get an international reopening with flights going back into the sector. And I haven't even addressed, all the stimulus focused on the property market. At this point right now, Whether, if you look at the property market and their hesitancy there in late 21 and 22, it was a focus on deleveraging. Now the focus is back on growth. And you think about, with the COVID policy or, the posturing China did with Russia, they're turning back to the West. They're focused on growth. And if they're focused on growth, commodities are going to be the best play in which you take advantage of that. And then if we turn to Europe, gas prices are over. The winter weather, it's over with. There wasn't a winter crisis here. Our view going into this winter is nobody gets hit by a train they see coming. They made the adjustments. The weather was cooperative. The story of the inflation front and the energy crisis is at least over, for at least the near term or foreseeable future. I'm not going to say in no way is the longer term secular problem over with in Europe, but at least near term, they've got a reprieve. And you can see it in the PMIs. They're rebounding. Indian PMIs rebounding. So that the only negative fly in the ointment is what happens in the U.S. And there you just digested, 425 basis points of rate hikes, and 325 of that was was mainly in the second half of last year. And as the market begins to become more comfortable with terminal rates, I can't see why you don't start to create the potential for upside. One last point, I know I'm belaboring your question, Jim, here, is when we look at the destocking, the sector has priced itself for a recession. Everybody, it's like recession obsession, yet there's very little evidence of it out there outside of some place like Europe or the COVID shutdowns in China. But I think the key concern I would have in all of this is the market has priced in a recession, physical suppliers, inventories, all of that is completely aimed like it's going to have a recession in 2023. What happens if you don't get one? And the evidence so far as we enter 2023 doesn't really suggest you're going to see one on a global basis. And our economists, they take the view, and it's a little bit, viewed as being, out of consensus right now. They're not in that camp of a recession.
Yeah, you're kind of preaching to the choir. I definitely am drinking the Kool-Aid. I agree with you on all those fronts. Particularly I would add, if we do get a recession, given the populist kind of response that we're seeing, you might actually get more fiscal, which could actually exacerbate things. So from a structural macro perspective, a supply and demand perspective, I agree. To be polemical a bit, and also because this is what I worry about on that side in the short term is, you mentioned nobody gets hit by a train they see coming, right? You're not the only one talking about this, right? A lot of people positioning is definitely a little heavy commodities right now. And that can always be a short-term headwind, right? Even if you're in a secular move. In particular, I'm on the vol side of things. I think there's this interesting dynamic that I'd like to highlight where, vol itself on the index level has compressed volatility this year on the equity index side. And with the liquidation in the tech names, that's meant structurally that there's had to be demand for somewhere else in the market, which has really flown into the commodity space. It's kind of the inner workings of the market machine. The more and more that vol becomes unpinned in the index level and correlations go to 1, if we do see a second leg down, I'm afraid structurally that commodities might actually be harder hit than people expect, because that's where people are hiding, if you will. Do you have any thoughts on market? I know you're broadly thinking supply and demand, more market microstructure, more economics, but short-term positioning, what that might mean for the commodity space in the short term.
Yeah, I find it surprising you say people are hiding in there. The space is unloved. We look at the index flows, we had $60 billion of outflows last year. When you look at the hedge funds that are devoted, you go back to the 2000s, there was like $80 billion. You're lucky if you can come up with 12 right now, and I can list them all on my fingers and my hands because that's it. And then by the way, there is money in the space, but it's in the ETF retail side. But it still pales in comparison to what we saw during the 2000s. So I don't agree with you. Even look at the equities. They're undervalued. The free cash flow yields are far too high on the equities, which means people still don't believe in the story. So when you look at, the market cap of energy in the S&P, it's running somewhere around 5 to 5.3% of market cap, but on a revenue basis, it's closer to 9 or 10, which tells you that, again, people are underinvested in the energy and commodity equities. The same thing can be said about metals and mining. I know in the index space, it's a total sleeper. People do not have, I just do not see the flows like we would have seen in any other super cycle. Now, do I think this is abnormal for where we are in the cycle? The answer is no. And I think, you look at the 2000s, nobody bought into this story until it was 2005, 3 years after it happened. And when I talk to asset allocators, they tell me that's relatively normal. And I go, you look at it, the reason why people are not hiding in this space, they may be on a vol basis, but they're definitely not on a flat price basis, is the history of the space is the losses were nothing short than epic. You look at the E&P companies in this sector over the last decade, they destroyed 54 cents on every dollar they were given. So no wonder nobody wants to give them any money. Commodities generated a 60% loss over that same time period. So again, no wonder why nobody wanted to give any money to this space. Nobody believes in it. In terms of getting people they're going to want to see a 3-year track record. 2021 posted 42% returns. 2022 posted 26% returns. They're probably going to need to see another big number in 2024 before they begin to think about it. I think we'll likely see some of that rotation begin to occur, but it's going to take probably another 18 months. And I've lived through 2 of these big transitions. I'm a firm believer the money, went to Silicon Valley, and we call that the revenge of the old economy. And we created that concept back in February of 2002 when the dot-com boom crashed, back then, is that, it was 2002 through 2005 that transition before people really bought into it. And I'd lived through the transition in 13, 14, 15, and 16. And you had to send the memo out over and over and over. And ultimately, the reality is the asset managers, I watched it in 13, 14, and 15. They send the memo out. Guess what? The China story is over, buy tech. China story is over, buy tech. And ultimately, you ended up having to replace the CEOs of the companies to get them to quit spending. You had to replace the asset managers to get them to quit investing in this space. And then finally, they bought into the tech story. Well, newsflash, memo, it's time to move back into the commodity space. But I don't think it's going to take another 18 plus months. I'd be surprised if it happens next year. So if anything, I kind of find it surprising you say it's been a place people have been hiding. Gold, maybe yes, but even there, it's not as much as you'd expect.
I want to stay maybe with energy for a little bit here and just sort of listening to other people, other guests we've had on the show. I'm thinking here about people, and I don't know if you're familiar with Peter Zeihan, the geopolitical strategist, and some of the things that he's been talking about. And one of the things I recently picked up from him was this risk of, and correct me if I'm wrong here because you're the expert, but when Russian oil flow starts to slow, water can build up in the pipes, and if you have a really deep freeze, they can actually blow the pipe because water expands, et cetera, et cetera. How do you see the risk of some real disruption coming from the changes in both kind of infrastructure, but obviously the whole trading situation with Russia at the moment? What do you see from that?
Yeah, with oil, we're off maybe 200,000 barrels a day, potentially 300 since the December 5th implementation of the price cap. And that's due to frictions, inability to find refineries that can take it, inability for ships to go into certain ports because oil needs the big deep water, ports and so forth. But it's not a catastrophic event in any shape or form. They're going to keep the oil likely flowing. The real problem comes with the products in February. And by the way, I agree with everything on the freeze-offs and all the other issue, which is why they're going to do everything in their power to keep those productions level there. I mean, it's old technology where they use lots of water in the production to generate pressure, so they have a whole host of reasons why they can't. The problem is on the product side. There, you don't have, it's not as fungible as oil. The gasoline has to be in a different ship than, let's say, their fuel oil or the distillate and so on down the line, which creates a lot of problems with creating the logistics to be able to redirect those products. And that's when we think you're going to get the bigger problems start to develop is in February. And we think you could lose, potentially another 600,000 barrels per day due to the inability to ship the product. So, yeah, I agree with those issues, creating restrictions. Now, it doesn't mean that you won't see a problem. And by the way, until this week, the eastern port, the Espoo and Cozumel ports out of Russia saw big declines. In fact, I would have been much more aggressive with this question before today when I saw the data of the rebound. And I would almost tend to think, now you're China. What do you do in this environment? The West is not taking the Russian oil. You're in the driver's seat. And I would tend to think if anybody who's going to do anything here, it's going to be the Chinese. They're going to, for the reasons you just cited, they're going to force the Russians into a corner. I would if I were the Chinese.
Sure. And just staying again with oil, and now we have Russia, we have China, but there's obviously one other big player, that's OPEC. Where are they sitting in all of this? I did hear them state after one of their meetings recently saying, well, energy security comes with a price, hinting very directly at the US, of course. But how do you see their newfound power? I guess they're maybe more powerful than they have been for a while, given what's happened.
I mean, the only two producers in the world on a country level that have reinvestment rates at the same level or higher than what they were in 2019 is Saudi Arabia and UAE. And that's where all your growth, that's your engine of growth. And in this new decarbonization world we're living in, you don't want to make long-term investments in things like deep water offshore platforms off the coast of Nigeria. That game's over with, and there's no capital going into those parts of the world. As a result, there's only three engines of growth going forward, all the fast cycle production, and that would be the United States shale, which is fast cycle, the Middle East production, which is all fast cycle, and Russia. You just lost one engine of growth in Russia. And now with the U.S., it's constrained with the inability to attract capital. That just leaves you with the Middle East as being your engine of growth. And so when you look at, if you can think about market power as being a function of the supply elasticity of other producers around the world, if they're all essentially vertical supply curves, then the market power of core OPEC, which is the Gulf countries, has never been higher, because their problem before wasn't non-OPEC, it was non-core OPEC. It was like the West African countries or Venezuela or somebody like that cheating on them. That doesn't exist anymore. So you can argue, going back since 1960, the inception of OPEC, the market power has never been higher. Which will put them in a very strong bargaining position. I'd say the Middle East more broadly is in a very strong position right now.
Yeah. Jim, before you jump in, Jim, I have just one final question, because I really don't know the answer to this. And that is, what about the strategic oil reserves? Have they stopped selling out of that, or is that still going on, Jeff?
No, it ends at in December, and as we go into the new year, you're going to be losing that supply. So here's why I'm so bullish as you go into it. You're losing upwards to 1 million barrels per day of SPR. You're gaining over 1 million barrels per day of Chinese demand, and you're losing up to 500,000-600,000 barrels per day of Russian supply. That's a huge shift in balances, which really creates the upside. And I don't think they're going to use the SPR in 2023 because they realize how well it worked going into this election in 2022. They'd probably wait to use it again in 2024.
Yeah, I couldn't agree more. I think on the Saudi Arabia note, I have kind of two points. One, in June of this year, President Macron was kind of overheard on a hot mic. You probably know about this, talking to Biden about Sheikh Mohammed bin Zayed of the UAE, claiming that neither the UAE or Saudi Arabia could produce more to help, reduce prices going into New Year. And that's that got less attention than you would think. There's a lot of speculation out there that the Ghawar oil field is actually reaching, is tapped out, right? So despite all the money being thrown into more production, they're getting less and less out of it in Saudi Arabia. So I'd love to hear your thoughts on that, if there's any research or anything that you've looked at there. And then secondly, volatility. I'm a volatility trader. We run several vol funds here. The vol in the oil space, I think, is a very interesting dynamic. My work broadly says that you had a Fed put, which has controlled Treasury vol and dollar vol for some time. But during times of inflation, you actually get a commodity put from major producers like OPEC, which is what we saw in the 70s as well. And they actually support price, but interestingly suppress volatility. You've seen volatility go up significantly in the short term in oil, and implied volatilities rise. And broadly, our work says that that's actually the one commodity, one asset that's kind of going the wrong way on. So I'd love to hear your thoughts on those two things.
I think, first with UAE and Saudi Arabia's transparency. Going back 5-10 years ago, pre the IPO, you could be speculating what you think, Saudi Arabia can or cannot do. Remember, it's a publicly traded company with very sophisticated investors on a global basis. If they say they're going to hit a target, they cannot miss their target. So I find what they say about their capacity right now to be more credible than it ever has been in, the existence, just because they need to attract capital. They want to attract capital. And similarly, you take the UAE, they may not do the IPO route, but they're taking a lot of these subsidiary companies, IPOing them and, trading them. Their credibility to global investors is incredibly high right now. So I think those arguments about, 10 years ago, 15 years ago about, I think Saudi's capacity is this or UAE's capacity is this, and they're not there. Now, if they say something and they don't hit it, they have serious financial consequences. Therefore, I would argue that what they say, and they'll do, and you watch what OPEC has done recently, they have done exactly what they have said. They have not deviated once because they know that credibility is so critical right now. So I'm not a buyer into, and by the way, I was a big believer in those stories back in the 2000s. And by the way, they're not claiming they have massive capacity right now today either. So, let's put it in perspective. But going to the point about, the put in commodities is, when we look at, their ability to manage the market, again, you had much high, more elastic supply curves back into the 70s. The U.S. could respond, it would respond, other producers around the world, which would take that volatility out. So they could provide a put in the current context, but is it going to do much when you have such inelasticity of supply elsewhere in the markets, and then also the other factor, bringing it into, monetary policy, when we look at the, what drives the oil market, one of the biggest drivers in the decline in prices in the second half of 2022 was a stronger dollar and higher rates. Here's the way I like to think about it. What's the definition of inflation? Too much money chasing too few goods. Well, the too few goods condition still holds in oil. What changed was there's far less money. And you think about someplace like Japan before this recent BOJ action, you looked at the yen, it went from 100 to 150. That means there's 50% fewer dollars to chase oil than what there would have been a year ago. Well, before the recent action. But I think, the key point there is there's a lot of other factors today that can, even if they cut production, as we saw in November. By the way, I want to make this point about that November production cut. Very first time in the history of OPEC, they preempted a demand loss. They've never could do that before because so much cheating would happen because of the higher supply elasticities.
I want to broaden out the conversation a little bit to maybe some of the other commodities. And again, just starting out with throwing out something that I again heard from Peter Zeihan very recently, something that I don't know the details of. He was voicing a particular concern about things like aluminum and titanium because of Russia and because of the massive amount of production, to a point where he said that he sees this becoming a massive problem for companies like Airbus, that they're essentially running out of the material to build the planes that, they're trying to sell. What are your thoughts on kind of the metal space? But I know that metals is not just one thing. It's really kind of a diverse field, maybe more so than the energy complex. What are your thoughts on this?
I agree with him that aluminum is going to be one of the most bullish commodities over the next 5 to 10 years. But I view it more, not so much from Russia, but even China itself, because when I like to call it the climate paradox. Aluminum creates the greatest amount of emissions to produce, but it's critical in solving climate change. For all the obvious reasons, because it's one of the top 6 green metals. And when we think about the curtailment in supply, whether if it's even in Europe more recently with the energy crisis, you think about China. In fact, here's why I'm also bullish about a rebound in China near term. They just put export tariffs on aluminum. It means they don't want the smelters operating anymore to export aluminum, which means they want to keep the energy domestic as you see a domestic rebound in activity. But what that means is, China produces a lot of coal to produce aluminum. Those activities are not going to be it. In fact, if anything, I agree with Peter completely on the overall outlook on Ali. And by the way, I don't know if out of all the different activities, the aircraft pay the most for the alley. So you got to really cut up into that demand curve before you hit the aircraft guys. But it's going to be a big hit to their bottom line because the upside here could be, massive. And by the way, I'll come to titanium, which I agree with him on. Those smaller commodities are the ones where I think are the bigger issue. But I think when you look at Russia, it's a low-cost producer, and they can produce green metal. So a lot of them would be focused on that. And by the way, on this whole point about boycotting Russian oil, Russian gas, Russian everything, let me remind you that the Americans, in 1990 said they would never buy Saddam Hussein's oil ever again. And 5-6 years later, with the oil for food deal, they were back in buying U.S. or Iraqi oil again. So, yeah, there may be a lot of talk. They're done with all of these Russian commodities, but the reality is, and we can talk about Russian gas, which I have strong views there. They're likely to be back, sometime in the, I'm not going to say near future, but sometime out there. But I think that the key point on Ali is it's got that climate paradox. You're going to have a huge increase in demand globally from green capex to create, low carbon energy sources because it can conduct electricity and it's super light. You can create products that don't consume as much energy. And then on the supply side, the coal production of Ali is likely going to be suppressed, which then Russia, by the way, has a lot of hydro and really clean burning production that people would like. So I'm not going to discount, that Russian supply longer term. But I agree with them 100% on the titanium. The titanium is also, they got huge market shares on these smaller rare earth type metals, and their impact on global growth, if they really wanted to do something and create problems for the West, it's those small, tiny markets that they have huge market share in that they could actually do something. I put, platinum, palladium, titanium. And right now, a lot of that's going out through China. But so I agree with him 100% on the titanium. I agree with a longer term outlook on Ali. I just don't agree with the Russian supply, because the Chinese supply is the one I'm watching near term.
You mentioned Russian gas, and I think it's appropriate to talk about gas in this conversation as well. So again, I'd love to hear kind of you freestyling a little bit in terms of your thoughts on where we are. It's obviously me also being situated here in Europe, big topic in many countries. Luckily, at the moment, we're seeing a little bit of a mild spell across the continent. But I think the problems that or my understanding is that the problems we may have expected for this winter might actually become even bigger for the next winter. And maybe you can also educate me on why that might be, if you share that view.
Okay, well, I mean, let's just let's do some broad numbers to give you an idea of the impact here. You look at Europe as a whole. It consumes roughly 45 BCF per day of gas. Russia pre-crisis represented 15 of that 45, so call it 1/3. It was a big supplier. Now, you didn't lose all of that Russian gas. You lost somewhere around 10 of it, because remember, there's some going to Italy, some going through Turkey, coming up, so it's getting there. You replaced of that 10, essentially 4 of it from LNG and 1 of it from coal to coal switching. So you got 5 back. So you're still short 5. And right now, they can bid away what would normally be going to China to solve this problem, to build the inventories up, plus a warm weather, you could deal with that mismatch. Now, the problem becomes, what happens? China comes back and you get a cold winter together at the same time in late 2023 and going into 2024, the problems begin to arise again. That's why I couch my excitement about a rebound in Europe as being more near term than medium or longer term, because the problems haven't gone away. And this is a global problem. And I think, as China begins to rebound, it'll become more apparent. When I say global problem, it's a problem for everywhere but east of Rockies, the U.S., where that shale basin exists. California's got it. So it's a global problem, ex-U.S. east of Rockies. So it definitely hasn't gone away. But I think, longer term, when you think about the viability of Germany Inc., it needs that Russian piped gas. You cannot operate a manufacturing sector off of LNG. I always like to say, ship the BMWs, don't ship the gas. Think about it. You need these multi-billion-dollar liquefaction plants to turn the gas to liquefy it, put it in a $300 million floating thermos that is being frozen, ship it halfway around the world to a regas terminal. Isn't it easier to move the BMW plant to the U.S. on the gas field, put the BMW on a normal ship and ship the BMW? So I'm not a believer. In fact, LNG was invented for the London fog problem in the 1950s. It's an emergency fuel. It's not something you run an economy off. And I know, some of the CEOs of big industrial companies in Germany agree with me on this view, which means either you're going to move those activities or you're going to resolve the problems with Russia. Because ultimately, a lot of that activity was created around that access to low, cheap gas coming into Europe. By the way, on that point, I learned something kind of funny not funny, but interesting. Why is all the petrochemical capacity sitting in Dusseldorf and places like that? The Soviets didn't want it on their own turf because they used to look at the Americans with all that petrochemical capacity sitting down in the Gulf Coast going, oh, that's an easy military target. So, Germany's got a lot of this stuff, and you can't operate it off of LNG.
What do you see as kind of the timeline for kind of a convergence, if at all, in gas prices, if the main way that's going to happen is through onshoring of manufacturing? Do you see that happening? Do you have a thought on how to play that, or anything along those lines?
I mean, you saw some of it. It's just basically you would shut down the aluminum smelters in Europe and turn on the coal ones in China, which is what China's telling you they're going to turn off in coming weeks. You see it with fertilizer moving from Europe to the U.S. Those are the easy, low-hanging fruit. And by the way, a lot of that, because America went through the same crisis in 2000, 2001. And when it went through it, basically all those activities moved to Europe because of cheap gas. And now they're moving back and going elsewhere in the world. But that's not a long-term solution, as you point out. Now, to get that convergence with the U.S., we saw it happen this last year through coal. They basically exported coal out of the U.S. into Europe. You get it through petrochemicals and in these other activities, but it never fully converged. And I think one of the key reasons it goes to the fact that you can get the supply in the Haynesville, you have the Marcellus, and other sources of supply in the U.S. that prevent the U.S. from fully converging to the rest of the world. Our view is the U.S. is going to be oversupplied. And it's going to be, difficult for the U.S. to capture it, but it has to come through those indirect channels like coal, petrochemicals, industrial activities, fertilizers, and things like that. But in the very near term, because of the warm weather, because of the LNG exports, because of the weakness in China, Europe doesn't need to converge. And I think that that's being reflected in the big pullback in prices we've seen more recently. Actually, if anything, Europe is converging to the U.S.
One commodity we haven't talked about is agriculture, grains, et cetera. There was a lot of talk when Russia invaded Ukraine about there being, famine and, obviously the problem with agricultural commodities, it also tends to create geopolitical problems, right? Stresses across countries. Just look at the Arab Spring, right? So would love to hear your thoughts, your current kind of thoughts, and if you're seeing any new high frequency data on ags and anything kind of more timely.
Well, with the El Nino effect in Argentina, prices are back to those Russia highs that we saw back in June. You look at soybeans, they're back to $16 a bushel. Corn's $6.77 a bushel. So we've gotten back up to really high prices on agriculture again. A lot of that's weather driven. However, when we think about the longer term story, I think these are still the tightest markets. And I don't think, I'm not going to go as far as call it famine. The system always finds a way to adjust, as we saw here in Europe with natural gas, and as you will likely see in agriculture going forward, but it doesn't mean it's not going to be painful. And when we think about the factors driving it, we call it the 3 C's. It is climate, conflict, and carbon. Those are the 3 C's. Starting with climate, yields are changing. As you see places like, the bread basket in the U.S. or, Mato Grosso in Brazil, the yields in these places are becoming constrained by weather. We've seen substantial weather shocks. I like to think about what's happening with agriculture in the U.S. It's kind of like the manufacturing problem in Detroit and the Midwest in the 80s. It had to move. People don't want it to move, but it had to move. And I think here with agriculture, you're going to have to go to more northern climates or places with better yields, and that's going to take time and create restrictions around supply. But I think so that's climate is C number 1. C number 2 is conflict, like we saw with Ukraine, but in places like Africa and other parts of the world, it's a relatively serious issue. But let's go to carbon. And I don't think enough is. And this goes back to the very first question you asked is, what's different about this cycle? It's the inability to invest in carbon-related assets. And I like to point out when we finish the year, what are the things that are up? It's all things that are carbon. And what is food? Food is a carbohydrate. It's the carbon-hydrogen bond. And I like to point out, what makes planet Earth planet Earth? It's the carbon-hydrogen bond. It's organic chemistry. It doesn't exist elsewhere. And when we think about food is a carbohydrate. Oil is a hydrocarbon. What is the difference between a carbohydrate and a hydrocarbon? It's an oxygen. That's the only thing that separates the two. And then how do you get a carbohydrate to turn into an oxygen, get that, or a hydrocarbon? Think about wood. Wood's a carbohydrate. It sits on the surface. Eventually, after thousands of years, it rots and it becomes oil, and the oxygen is gone and it becomes a hydrocarbon. That's about it between the two, but there's still that carbon-hydrogen bond. And so when we think about the underinvestment in carbon, it's hitting pretty much, it's hitting the agriculture sector, it's hitting the oil sector, it's hitting the metals and mining sector, it's hitting all of these sectors. So you get that same underinvestment dynamic, hitting it. So again, the 3 C's, climate, conflict, and carbon, are creating a structural bull market in agriculture.
Just staying on the climate, I know we only have a few minutes left with you, Jeff, but just staying on the climate thing, we actually we did a conversation just a few weeks ago with a weather cycle analyst, very fascinating. And I've also heard, I think, one of our other guests, Simon Hunt, both on our podcast, but also on Grant Williams' podcast, talk about that NASA and I think there was one other large institution essentially tying global warming to sunspots, and that the sunspot cycle was about to turn in the next 2 or 3 years, so to speak. I mean, is this kind of stuff things you also look at, that you have opinions about, whether, because I know you have, I think, some strong opinions about ESG, because obviously it has had a huge impact on lots of things. And by the way, before I forget, I do want you to tell everyone shortly how little impact all the windmills in Germany has had so far, and all the money we've put at it. Not that I don't think any of us disagree with the aim of what we're trying to do in terms of creating a better world, but just some of the ways we do it. But just going back to these things in terms of what you might think may be going on in terms of global warming that people are not actually wanting to talk about?
Bottom line, I mean, the uncertainty bands around climate change are so large you can drive a truck through them. And so do we know with certainty what's causing it? Do carbon emissions? I go back to the basic concept is you take Venus, it's got a lot of CO2 in it, and it's really hot, the stuff, that's my basic bonehead of thought process through this. But statistically, I mean, I have to agree with you that, we don't know. And we don't know. Maybe it's good, maybe it's bad. We don't know. But here's the way I like to think about it. The risk of it, what if it's really bad? Why take the risk? It's expensive. But here's my problem is we're not addressing that problem and the risk around it in a rational manner. And that's my dislike for ESG is let's solve this problem, but let's do it in a rational manner that actually gets results. And if you were really wanting to get results and get rid of carbon, we got so many technologies available at our disposal to get rid of it. Nuclear sits high on that list. And we think about, renewables. We've put, something $3.8 trillion over the last decade, which moved before the Russian event, moved hydrocarbon consumption from 82% of our primary energy source to 81%. So did very little. And by the way, there is investments in synergies of building out the logistics, so I don't want to ignore that. But I think, in terms of trying to solve this problem, I'm not sure renewables is the right answer to deal with this. And here's a couple points I'd just like to leave the listeners to think about is when we think about energy and energy waste, the damage we're doing to the world to create energy, it's directly proportional to the density of the energy. Let's think about wood. We started with wood. It has a lot of waste. It has ashes, carbon. By the way, it emits a lot more CO2 than coal does. Then you go down to coal. It has less emissions, less waste associated. Then we went to oil, had less. Then gas, less. Then nuclear. Think about nuclear. A coal power plant. All the waste sits in something the size of your fist. No carbon emissions whatsoever. And by the way, if we just cared about getting carbon emissions down, we replace all the coal with gas immediately. And then we would, use nukes and really take it down. Now, why do I bring up that progression of density? And why is it important to the discussion? Think about renewables. We're going backwards in time, worse than wood. Think about how big those wind farms are, how big those solar farms are, how much destruction we're doing to the environment. There may be no carbon emissions, but the amount of destruction associated with them are substantial. So you're going the opposite direction. You're creating lower energy density, which means you have more waste associated with it. Now, I'm going to throw out some stats. 165 people die each year of the ice coming off of the wind turbines. I'm not going to get into the debate about about Fukushima, about how many died, but I can tell you it's probably much less than 165 per year. And by the way, coal, it's like 6 million people die because of coal. And we're burning more coal this year, 525,000 tons more coal this year, and it kills a lot of people. And emissions are going to be up somewhere in the tune of, I think we have them up 4.3% because of all the coal being burned. So I think you get my point on here. I think, to answer your question, I don't know about it. I think the risks are so high that it's something really bad that we need to do something about it. And why not when you have, replace the coal with gas? It just cleaner burning. It doesn't, more lives will be saved. Replace, use the nukes. We know they work. So in any way, I know I'm going into some politically dangerous topics here.
No, it's fine. It's fine. I also want to add to your list, which I thought was an excellent list, is the fact that nobody talks about the amount of energy that goes into producing the windmills and all the other stuff, which is just and resources, by the way. Jim, you get the last question. Quick one.
Yeah, just to put a bow on this. Okay, you've convinced us, right? We're in a commodity super cycle. The name of the show is Top Traders Unplugged. If you're looking a decade forward, what is the most asymmetric way to profit on the commodity super cycle? Is it something as far afield as, hey, we need more carbon supply, Venezuela, like find a way to just look there? The U.S. is obviously going to have to turn and find, commodities. Is it nuclear? Is it, and then what are the ways to, what's the trade?
The bottom line is you need to have trillions of dollars of CapEx in this space. The equities are going to be the conduit. And so owning the equities, you want to own some of the commodities as inflation hedges. So a basket of the commodities, you capture that upside. And uranium would be an excellent example of something you'd want to own in this environment. You want to own the metals and miners because they're going to enable the green revolution through production of everything from the big green CapEx metals, which are copper, alloy, silver, nickel, lithium, and cobalt. Those are the big six. And then you have the rare earth metals. And so you need that investment. So those are going to be the places and the opportunities. But if you put a gun to my head and ask me, which one of all these commodities do I want to own? Oil is the biggest one of the bunch. It's the most strategically important. It's the one that drives the macro variables. And you cannot stop investing in something that's strategically and critically so important. It's going to, and here's the question. I don't want to get into the politics of, whether it's right or wrong investing in it or what. The bottom line is people are not stopping consuming it. And the only way you're going to get people to stop consuming it, you got to tax them. Goes back to my very initial point. You need a carbon price or a carbon tax. But if they're quitting, if they're not stopping consuming it, and you're not investing in it, and that gap gets bigger and bigger, and it's super inelastic, that's the one that could, create a lot of volatility going forward.
Great way to end our conversation. Jeff, this has been a tremendous conversation, as I knew it would be. Thank you so much for doing this today. Before we go, let me just say that you need to make sure and follow all the work that Jeff does, because as you can tell from today's conversation, we're living in a true global macro and commodity-driven world, and it is perhaps more important than ever before to stay well-informed. From Cem and me, thanks so much for listening. We look forward to being back with you as we continue our Global Macro series. In the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.